residual income valuation. We will follow the format in the curriculum, focusing on core points and on examples. Okay. This is the last equity valuation method that we will study. So let's just get the core concept. What does residual income mean? You saw this briefly in corporate finance. Now there is a whole reading on this topic. So residual income, as the term implies, is net income less a charge for common shareholders' opportunity cost in generating net income. So conceptually, this is very straightforward. The income statement that you look at, it's created from the perspective of which provider of capital? Debt holders, preferred shareholders, equity. So generally, it's from the perspective of shareholders or common shareholders. Okay, so you look at this net income at the bottom. Has there been a charge for debt before we came up with this? So effectively your cost of debt is the interest which has been subtracted before you came to this net income number. Now all residual income is saying is that if you invested equity equal to 10 million in this business, then just the way we subtracted this charge for debt, similarly there should be a charge associated with the money that you've invested. So if you raised 10 million through equity and the cost of equity RE was say 10%, then we are really making money if this net income is greater than the cost of equity. So if the cost of equity is 10%, then on an annual basis, our cost of equity is 1 million. That's the cost of raising 10 million in equity. So that means that if our net income is 1 million, and of that 1 million is just covering the cost of equity. So in real terms, after adjusting for the cost of raising money, we've not generated any real wealth. We could have invested that 10 million in a bank or wherever we are raising that money from, we could have generated that 10%. So the core concept behind residual income is it's the income after subtracting the cost of equity, okay, or the cost of capital. That's the core point, and now the whole lecture is simply going to build on that. So what is the appeal of residual income? Profit and loss contains a charge for debt, which I mentioned, that is interest cost, but not the cost of equity. So now we are also factoring in the cost of equity. A company may have a positive net income, which on the surface might seem good, but that might not be enough to meet the cost of equity. So a residual income highlights that issue. Related concepts you will hear in economics. You studied economic profits, you will hear abnormal earnings, economic value add. This is the core term that we will see again. So anyway, this is just planting some terms in your head that we will get to soon. Okay. If you get a question on residual income, a guaranteed question is calculated. Okay, so and again, I don't think the questions are going to be very difficult. It's just if you understand the concept, you just need to have some practice applying the concept. So let's do that a few times together, and then I will make you do some questions. So we have Axis Manufacturing Company that has total assets of 2 million, financed 50% with debt, 50% with equity. The cost of debt is 7% before tax, 4.9% after tax. The cost of equity is 12%, and the company has operating profit of 200,000, tax rate of 30%. Estimate the residual income. So what was the concept behind residual income? You want to come up with your net income, and then you want to subtract your cost of equity. What's the cost of equity? It is the sort of formula you will see is net income for time t minus the cost of equity times equity. Now logically, should this equity be the equity at the start? So the way you can think of this is let's say this is end of year t, then this is end of year t minus 1. All right. So if this is end of year 1, then this would be year 0. Should the equity be the equity at the, and this is the year where we are generating net income, okay, this is net income for year T. Should the equity be at the start of the year, end of the year, or average? Yeah, the logical thing is start of the year, because that's when conceptually you have invested your money. So for the equity invested here, you generated this net income. So we are making a simplification. Obviously, it's possible that equity was injected partly along the way, but the simplification we make is that we look at equity at time T minus 1. Okay, so now all we need to, so this formula represents our residual income. What's net income for period T? We are given EBIT, we are given the interest, so we do EBIT minus interest, and then we minus the tax. So our net income is 91,000 minus we are given a cost of equity of 12%. And what is our equity at the, what's our equity capital at the start of the year? 1 million. How do we know that? Because total assets are 2 million financed with 50% debt, 50% equity. So you do 0.12 into 1 million and you will get an answer of minus 29,000. What does this mean? Yeah, this means that actually even though the net income might have looked good, but when we put in a equity charge, the cost of raising the 1 million equity, when we consider that, we are actually losing value. Is this a useful thing to know? Yes. Yeah, it is useful. So that's the value of residual income. So this is a guarantee. If you do get, first of all, residual income is not a guaranteed case. I can tell you the free cash flow to firm or free cash flow to equity, that's a guaranteed. Your equity, I think, is 20 to 30% of the exam. So that means 4 to 6 case studies. Of that, at least one is free cash flow. One will be on multiples, and then the remaining 2 could show up from anywhere, including residual income. So if this shows up, then you need to know this formula. Has everybody memorized this formula? Net income minus the cost of equity multiplied by your equity at the start of the year. Okay, memorized? Now, there is another formula, so which you also need to know. There's another approach to coming up with your residual income. In the first approach, we took the equity investment and multiplied by the cost of equity. Now another way is to take the perspective of all providers of capital, both debt and equity. So now you look at EBIT. Is EBIT available to both providers of capital? Yeah, because it's before interest. So you look at your operating profit after tax. So this is your, for a given year, this is effectively the money available to, or the income available to both the debt holders and the equity holders. And now notice that we subtract total capital times WACC. So WACC represents a weighted average cost of capital for all sources of capital. Okay, so this is a different approach to come up with roughly the same answer. Your WACC is 8.45%, and I'm sure you know how to calculate WACC. Okay, the operating income was given, you subtract the tax, so you do that, minus, what is this? Total capital multiplied by the WACC, and you get the same answer. So 2 ways to come up with residual income, you need to know both. So just as a quick refresher, the approach 1, residual income, was equal to your net income for period T minus cost of equity into the equity investment at time T minus 1. And approach 2 is residual income is your EBIT, and then you take away the tax and then minus the total capital multiplied by WACC. So conceptually simple. make sure that you memorize it so that there is no issue on exam day. The question is, isn't a debt deducted pre-tax? So there is a bit of a simplification going on over here. Okay, so there are many other adjustments, but big picture, just these are the formulas you need to know. Okay, now many of you in business school have studied maybe some of these concepts. So economic value add. So there is a consulting company, the name of which I can't recall. So they have taken this residual income concept and created a branded methodology called EVA, or economic value add. Many textbooks, finance textbooks, make a reference to this. Okay, so effectively EVA is calculated using the second approach that we just talked about. So the economic value add is effectively your residual income. So it is your net operating profit after tax minus this effectively is your WACC multiplied by your total capital at the start of the year. Okay, so now in your curriculum you will notice that in this branded method there are 7 or 8 adjustments that are made to accounting values. So to come up with the NOPAT that is used in this analysis, there are several adjustments. So for example, deferred taxes are not included. Operating leases are converted into finance leases. So I doubt that you will be asked about those specific adjustments. If you are really fussy about it, give it a quick read, but most likely you just need to know this concept. So remember that EVA is effectively a commercial implementation of residual income calculated using the second approach that we just talked about. Another term that is thrown around is MVA, or market value add. All this term means is that you look at the market value of a company minus the total capital. So if the market value of a company is 150 million and the total capital that has been provided is say 120 million, then the MVA is 30 million. So management can often be measured based on how much value has been added. So if the value of a company is equal to the value of the capital that has been provided, that means management is not creating any value. On the other hand, if management is doing a good job and setting things up so that future cash flows are very high, will that impact total capital or will that impact the market value? That will impact market value. So the MVA is a good measure of how company management is performing. Okay, so why do you think we are doing this? What we have done so far is we've understood what residual income is. Now remember, this whole study session is on valuation. So we are going to use the concept of residual income to value a firm. Okay, so now when we say the residual income model, this is a model based on residual income used to value a entity. So you've learnt sort of one formula, two flavors. Now we are on the second formula, which will have also a few flavors. So this is the somewhat intuitive formula that you must remember, and you will notice that the other formula is just the same thing given what we've learned. But let's make sure we understand this logic. The value of a firm is equal to the initial book value, which is effectively your initial, let's say, equity that you've invested, plus the present value of all the residual income that you are generating. Intuitively, do you think the value of a firm will go up if residual income is zero in the future? Doesn't make sense, right? So if you are not generating any value above, so if there is no residual income, then the value will simply be the initial book value. It will not go up. So what this residual income model is saying, and sometimes this is also called RIM, all this is saying is that the value is equal to initial book value plus the present value of all the residual incomes in the future. Now, do you see the equivalence between this and this? All that's happening here is, instead of residual income, we are replacing that residual income with the definition of residual income that we just studied. Okay, so residual income is what? It is, what does, now this is slightly confusing, but what does this E stand for? Yeah, so this, don't confuse this with equity. The E is the earnings. Earnings for a given period minus what's the R? R is cost of equity, and B is your book value or equity capital at the start of the year. Okay, so do you notice that? So can you memorize these two? It's very straightforward. It's like everything else you've studied. The only distinction or difference is now we do book value plus the present value of all residual incomes in the future. Okay, so 80% of what you will get on this reading can be solved based on what you've already studied and what you know from previous topics. Okay, so all this we've discussed. Okay, now this is applying what you have just learned both in this reading and what you have learned earlier with level 1 and level 2. So give this a read, think about it, try to jot down how you would do it, and then we'll work on it together. Okay, in case you haven't figured it out, all this verbiage over here, all that you really need out of this is that the cost of equity is equal to 9.3%. Okay, so you had to read all that to come up with that piece of information. So now for 2007, so let's do 2000, let's for 2000, so 2007, what is our residual income? How will we come up with the residual income in 2007? What was the basic initial formula that we came up with? Yeah, so it was our it is our earnings. No, what was the formula for? So it is net income minus. Yeah, always, just as a quick tip, whenever you see a residual income formula, before you get hung up and start reading all this, just quickly jot down the formula. Some people, when they read a lot of junk, forget the formula. Okay, so just write down the formula before you read the junk, and then the formula will be in front of you. So RE multiplied by what? Your book value or equity value when at the start of the year. Okay, so at the very least we should quickly be able to do this. Should you get confused by dividends and so on at this stage? No, the dividends will come later, but don't get confused by all this. At least do your residual income for 2007. So what is the net income? So it is 2.71 minus cost of equity is 0.93 minus what's our equity? Yeah, we are doing on a per share basis. So book value per share is into 13.46. So whatever that comes out to be, so that comes out to be 1.46. So that's your residual income for 07. Okay, now to come up with your residual income, why, first of all, bigger picture, why do you think we are coming up with residual income forecasts? Yeah, because the value of this company is equal to the book value at time 0 plus the present value of all the future residual incomes. Okay, now to come up with the residual income for 08, what do we need? Now we will need to figure out, since we will need the book value at the start of 08, now we will need to use the fact that we have earnings, some of which are retained and some are paid out as dividends. So that's where this dividend forecast will come in handy. If we are not told that there is any other paid in capital, no other equity contributions, then what will the equity value be at the start of 08, or the book value at the start of 08? So it will be this plus the earnings and minus the dividends, and then you use the same formula to come up with net income. So In the interest of time, I'll just share the answer with you. You hopefully gathered this. So this is a structured way of doing it. 13.46 was your initial book value. What is this doing over here? 2.71 is your earnings minus the dividends. So that is your, what is this? That's the retained earnings. And what's this? So you've simply come up with your book value. So how will you now come up with your residual income for 08? So you have your book value at the start of the year. Why are we multiplying by 0.093? That's the equity charge. So our total equity charge is 1.41 for 2008. What is this 2.86? That is our earnings forecast. And then we subtract the equity charge and we come up with 1.45 as our estimate for residual income in 08. Okay, so fairly straightforward. All we've done is figured out how to create estimates of residual income into the future. Okay, now again, given all that you've studied, this should not be hard. What do you think the next step will be? Yeah, we've understood residual income, we have understood how to forecast it, and now we'll simply use the residual income forecasts to value a company. Okay, let's see if you can do this. This is example 3 in the curriculum now. Okay, so I just want to make sure you're on the right track here. So if you just follow the procedure that we just discussed, you need to find the residual income for year 1, year 2, year 3. What you should get when you do earnings per share minus the equity charge, for year 1 the residual income should be 1.4, for year 2 residual income should be 1.8, and then for year 3 the residual income is 3.175. In this artificial made up problem, this final, the company, the final dividend is a liquidating dividend. So how do we come up with the value? The value of the company at time 0 is simply the book value at time 0 plus the present value of all those residual income. So you discount back somewhere here, they should have given a discount rate of 10%. So 1.1 plus 1.8 over 1.1 squared plus 3.175 over 1.1 cubed. You should be able to do this in your sleep, and you simply discount back and get your value. So there isn't much to it. Once you've understood the core formulas, you should be able to do this. Okay, you can get an answer and verify it. The final answer should be 11.15 should be the value. The value for book is, current book value is 6. So that is 6.00. Okay. All that is being said over here in the third part, confirm your valuation using the discounted dividend approach. And if you simply take the dividends and discount them back, which again you should be able to do in your sleep, you will notice that you get the same answer. So as long as your assumptions are consistent, then theoretically these two methods give the same answer. Okay. So this is just that problem that has been done for you. Now, I just want to highlight of the various details that are mentioned. Here is a critical point. So just if you're doing the numbers, just pause on the numbers because you can practice that later. You need to be able to get these numbers. So numbers is very important. The other important point is one important concept. So I'll read this with you. In this example, the residual model attributes 6 of the 1115 to the first time period. So remember, when we came up with the value, we had $6 out of this $11 value is coming from the initial book value. Okay, which relies less on our forecast of the future, versus when you use a dividend discount model. So this is in the residual income model, versus in a dividend discount model, in our value a major part of the chunk comes from our assumption about some terminal value. Okay, and what's the first value? For V naught, you have D1 over 1 plus R plus D2 over 1 plus R squared. The numbers which numbers typically in your forecast are you most sure about? The numbers that are near or the numbers that are far away in time? Near. So the problem with the dividend discount model is that most of your value is coming from numbers that are far away, so which are very sensitive to your assumptions. Okay, so a slight change in assumption will have a big change in terminal value, and the terminal value is a big chunk. So actually in the dividend discount model, that terminal value 9.2 was a major chunk of your estimate. So do you see an advantage of the residual income model? It is putting more weightage in the numbers that are right there in front of you today. Okay, so this model is less susceptible to mistakes due to forecasting error and so on. Okay, an important point. And it's one of the learning objectives to understand this distinction. Is this an advantage over other cash flow models? Yeah, so this is an advantage over all cash flow models. Is this an advantage over market valuation models? Yes. No. The market valuation models are based on comparisons, multiples. Okay, a more precise answer would be if you are coming up with relative value based on comparing multiples, then it's not an advantage. If you are coming up with PE ratios based on fundamentals, the justified PE, then justified PE method is essentially practically like free cash flow discounting back. So this is not an advantage over the price multiple method where you are using comparisons, because there you are just coming up with value based on comparing with similar companies. Yeah. Yeah, so this is somewhat subjective. Although the very simple point we are making is with residual income, obviously most of your value is coming from the current book value, which is reasonably objective. So most of your value is coming based on something you can measure. Now, what is the obvious disadvantage? The disadvantage is if the book value is not accurate, then you have an issue. But as we'll see later, is that something that will completely throw you off, or can you do something about it? You can make adjustments. Is anybody stopping you from making adjustments? No, so make adjustments. All right, so we'll see that later, that there are some limitations to residual income. Right now we've just understood one reason for why it is better than free cash flow models. But there are limitations that we'll talk about. Okay, one of the limitations of the residual income model is that it assumes a clean surplus relation. How many people know what clean surplus versus dirty surplus means? Okay, so you will know very shortly. Clean surplus relation states the relationship among earnings, dividends and book value as follows. So basically when we say clean surplus accounting, what we are saying is that all our increase in equity is flowing through the income statement. When does this not happen? Remember when you have other comprehensive income? Do you recall the 4 reasons now that you are midway or past midway through level 2? In level 1 you just understood 1. You just understood the unrealized gains in AFS. No, that was the one you learnt in level 1. Unrealized gains in available for sale securities was categorized in OCI. There are several other items that do not show up in the income statement and directly increase equity. This included unrealized, so this has to do with cumulative translation adjustments and something to do with pension accounting. So we don't need to get into details, but there are several areas that cause net income that do not go through the income statement and straight hit equity. So when that is happening, then that is not clean surplus. Okay, now residual income based on the model that you have studied assumes clean surplus. Okay, so that's a limitation. But is it something that, so what do you think an analyst should do if there is a company where a lot of the earnings or the lot of equity increase is going straight to OCI? You can actually show that, make an adjustment and show that as net income. Okay, but anyway, just at face value on the top, residual income models are based on the assumption that the clean surplus relationship holds for the subject company. So at the end of the slide, everybody understands what the clean surplus relationship means? So clean surplus relationship means that all change in equity flows through the income statement and comes from retained earnings.